I don't think gold's going below 4,300. So if you're buying it now at 4,500, I think there's minimal downside in gold at 4,500, right? Silver, a lot more volatility, which to me makes sense given the magnitude of the breakout, right? We blew through 50. I mean, we basically paused there for a couple of weeks maybe, and I was forecasting on this and on my main podcast that once silver broke above $50, it was going to be a moonshot and that 50 would be support. Well, 50 was only support briefly. I believe support is now 70. I don't think we're going down to 50 at all.
The recent performance of precious metals reflects a decisive shift in investor behavior, with gold and silver moving together rather than diverging as they have in past cycles. Gold delivered an exceptional advance, reinforcing its role as a monetary anchor during periods of fiscal imbalance and currency erosion. Silver, however, transitioned from laggard to leader as the cycle matured, accelerating sharply once confidence in financial stability weakened. Peter Schiff has consistently argued that this pattern is typical of major metals bull markets, where gold moves first to signal stress, and silver follows later with amplified momentum once broader participation begins. As the cycle progressed, the rally broadened further, drawing strength from both investment demand and structural constraints. Gold's steady rise suggested a repricing of long-term monetary risk, while silver's volatility underscored how thin the margin of balance has become between supply and demand. Schiff has emphasized that silver's dual role, as both an industrial necessity and a monetary hedge, makes it particularly sensitive when economic uncertainty overlaps with physical scarcity. This dynamic helps explain why silver often advances in powerful waves rather than smooth trends, especially when paper pricing mechanisms struggle to reflect real-world conditions. What stands out now is that the advance is no longer confined to the metals themselves. Mining equities have begun to reflect the improved economics created by higher metal prices, lower relative costs, and expanding margins. Schiff views this as an important confirmation, noting that equity markets typically lag until profitability becomes undeniable. Despite strong gains, he maintains that valuations across the sector still fail to fully account for the earnings impact of sustained gold and silver strength. In that context, the ongoing move appears less like a speculative spike and more like a structural revaluation driven by monetary reality rather than enthusiasm alone. Now, we present the clips from Peter Schiff's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Gold closed this week on a positive note, up just over $30 an ounce. We closed at 4,508, so above 4,500. Silver didn't quite close above 80, although it traded above 80 again this week. It traded above 82.50, but it was up almost $3 on the day, closing just below 80. I think it was 79.84. But percentage-wise, gold is already up 4.6% this year. This is only the 10th of the month, 10 days into the year. Of course, most of them weren't even trading days because of the holidays and the weekends. But you're up 4.6% already. Silver is up about 12.5% so far in 2026. So just picking up where last year left off, the precious metals bull market continues. Platinum again up about the same amount, I think, as silver. Also, look at what happened with the mining stocks, because another knock on the gold bull market was the lack of confirmation in the mining stocks, because the mining stocks were lagging. They're supposed to be leading. Mining stocks are supposed to be stronger than the metal in a bull market. That wasn't the case. But of course, that's why I was pounding the table, especially early last year. In fact, I put out a special report, I think in April, the best way to buy gold, and that was buying gold stocks, because gold stocks had barely gone up on the year, even though gold was above $3,000 an ounce. Well, the GDX, which is a gold stock index, finished the year up 153%, and the GDXJ, which has some mid-caps, more mid-caps. It's called juniors, but they're not really juniors. They're just a little bit smaller than the GDX. That index was up 166%. last year, and off to a strong start again this year. The GDX is up 8% so far in 2026, and the GDXJ not that much farther behind, up about 7.2% so far on the year. But these stocks are now outperforming the metal itself, which means now everything looks like a bull market. You can't say, well, you're not seeing a confirmation in silver, because we are. Oh, we're not seeing it confirmed by the mining stocks. Well, we have. And in fact, one thing about the mining stocks is that even though they've outperformed the metal, they didn't outperform it nearly enough, given how much gold and silver prices have risen and how great an impact that's going to have on earnings of these mining companies. Stocks are still very cheap. And that's still, to me, a positive contrarian indicator in that the investing public still doesn't appreciate how cheap these gold mining stocks are and silver mining stocks are. They still don't get the significance of the bull market. They're still distracted, by the tech bubble or the crypto bubble, and they're not really paying attention to this opportunity, which is why investors should still be buying not only physical gold and silver at these prices, but especially the mining stocks. And, the gold mining stocks, not only are they going to make a lot more money because the price of gold is going up, but look at oil prices. Oil prices are below $60 a barrel. They're about $58 a barrel. That is the most significant cost in gold mining is energy. And that's going down. Now, I don't think oil prices are going to stay down, but they're down now. So this is great for the profits of the gold miners. But also, silver going up is going to have a major impact on gold mining companies, because pretty much all the gold mining companies mine some silver. It's a byproduct of gold. And the way they report it, it's not earnings from silver mining, but the money they get from their silver, they use that to offset the costs of mining the gold. So that means not only are mining costs going down because of low energy prices, but because they're getting so much from their silver byproduct. That is dramatically reducing the cost of their gold, and it is going to be reflected in their earnings. So all the gold stocks are going to benefit from higher silver prices, even though people aren't buying them because they're silver miners. They still mine a lot of silver, and it makes a big difference on their net costs of mining gold. And of course, there are companies that just mine silver, and they were the star performers of 2025. But again, given how cheap they were when the year began, they're still cheap now, despite tripling and quadrupling on the year. So even though we've seen this rally, you want to buy gold, you want to buy silver. Gold, I don't think there's very much downside risk at all. I don't think gold's going below 4,300. So if you're buying it now at 4,500, I think there's minimal downside in gold at 4,500, right? Silver, a lot more volatility, which to me makes sense given the magnitude of the breakout, right? We blew through 50. I mean, we basically paused there for a couple of weeks maybe, and I was forecasting on this and on my main podcast that once silver broke above $50, it was going to be a moonshot and that 50 would be support. Well, 50 was only support briefly. I believe support is now 70. I don't think we're going down to 50 at all. The opportunity to buy $50 silver is gone. And I hope a lot of people took advantage of it before it left while it was here. In fact, all last year, I told people, buy 30, right? 30 is the new 20. Silver's not going below 30. Then I said, buy 40, 50. Now I'm telling people to buy $70 silver if you get the opportunity to buy $70 silver. The low of the pullback after silver got above 83 was just above 70. And ever since silver got above 80, it's never been below 70, although it's gotten down there. I think the real support zone is 71 to 75-ish. So that's probably the best place to buy it. But the problem is, I wouldn't wait for 71 or 72. I just buy it at 79, because here is the problem for long-term silver buyers. I'm talking about physical silver. I'm not talking about people who want to trade it on the COMEX, doesn't really matter. I'm talking about if you want actual silver delivered to your house, like we do at Schiff Gold, you just got to buy it now. And that's because I expect the premiums on silver products to soar in 2026.
Peter Schiff has repeatedly highlighted the growing threat posed by the United States ballooning deficits, warning that the nation is running on a fiscal trajectory that is increasingly unsustainable. The federal government continues to spend far beyond its means, with annual deficits exceeding $3 trillion and total national debt fast approaching $40 trillion. Schiff emphasizes that this chronic overspending is not just a temporary problem caused by crises or emergencies. It reflects a deeper structural imbalance in government finances. Entitlement programs, rising interest payments, and politically driven spending priorities are creating a cycle where borrowing becomes the default solution, rather than addressing productivity or economic growth. According to Schiff, this reliance on debt expansion undermines the long-term stability of the economy and limits the government's ability to respond effectively to future crises. The ripple effects of these deficits are already being felt across the broader economy. Schiff points out that constant deficit financing forces central banks into accommodative monetary policies, effectively masking the fiscal weakness but simultaneously eroding the value of the currency. Inflation, rising interest rates on future debt, and weakening confidence in government-backed securities are all direct consequences of this imbalance. Investors, Schiff warns, are increasingly seeking alternative assets such as gold, silver, and other tangible investments as a hedge against both inflation and fiscal instability. If deficits continue unchecked, Schiff argues, the U.S. faces growing economic fragility, potential currency pressure, and market volatility.
Deficits are rising over $3 trillion a year. The national debt is now over $38.5 trillion. Will probably be over $40 trillion by the end of the first quarter of this year. We'll have a $40 trillion national debt. That is why the world is moving away from the U.S. dollar into gold. Now, what we haven't seen certainly not in the back half. Last year was a weak year for the dollar, but the last half of the year, the dollar was kind of flat. And in fact, the dollar index closed today at about a 1-month high, back above 98. But if you're looking at the dollar yuan, the Chinese yuan, the dollar is at a 2.5-year low today. It's back below 7-1, but it's a 2.5-year low. This is significant for many reasons. But one of the ways, in fact, the main way that Trump's economic team described how China was going to eat our tariffs, it was going to be their currency was going to go down. And because their currency was going to go down, that was going to bring down the price that Americans would have to pay for Chinese products. So Chinese were going to have a weaker currency to offset the impact of the tariffs. So even though the tariffs meant higher prices to Americans, a lower yuan meant lower prices because the dollar would go further. Well, the opposite has happened. The opposite of what Trump's economic advisors said was going to happen has happened. Instead of the Chinese currency going down, right, so that we got a bargain, it went up. So now not only do Americans have to pay the tariffs to buy Chinese products, but now they have to pay more dollars to get the yuan to buy Chinese products. So it's a double barrel that the American consumer is getting hit with. But it also shows that China's winning the trade war. Their currency is going up. And even though China's exports to the United States have gone way down since Liberation Day, overall exports have gone up. They're just trading more with the rest of the world. They haven't missed a beat. What Americans aren't buying, Europeans are, or people in South America, or people in other Asian countries, or maybe more Chinese are buying stuff, just the way I said. So China didn't need the United States. It's the United States that needs China. We need China for their products, and we need them to loan us the money, that we need them to buy our treasuries. And that is the other big problem that you're going to have. Look at the yield on the 10-year Japanese government bond, over 2.1%. I predicted last year that the yields on the 10-year Japanese government bond would rise above 2%. They were less than 0.5% when I made the prediction. But rising yields in Japan is going to put a lot of pressure on the Japanese government to sell U.S. treasuries. They are the largest holder of U.S. treasuries right now. They're going to be selling. They're not buying. And, of course, the rest of the world is not buying treasuries. They're selling. They're buying gold. They're going to buy more gold. I think central banks will buy more gold in 2026 than they bought in 2025. Not just the central banks that have already been buying, but other central banks who stood by and didn't buy. While other central banks did, they're going to buy, right? They're going to be FOMOing into the gold because they're going to need gold as part of their reserves. I mean, gold last year replaced the treasuries as the largest reserve asset of central banks. That is going to continue. That trend is a massive and important trend that is going to be going on and on for many, many years. And that is also going to fuel demand for gold. But now you're also going to have individual investors really stepping up their demand. They were pretty much absent last year. They're not going to be absent this year. This is going to be the year that Wall Street wakes up and discovers precious metals and the precious metals mining companies. So everything is bullish. And I think, Donald Trump's foreign policy is also going to backfire, just like the tariffs are backfiring, alienating our friends, alienating the countries that we rely on to supply us with goods that we don't produce, to loan us money that we don't save. We are our own worst enemy. That is the problem. But the adventurous foreign policy is going to backfire because it is going to lower credibility of America. And I think it is going to make other countries, again, question why they want to embolden and empower the United States by using the dollar as the reserve currency, by handing the United States this weapon, which it then turns and uses against them. Because if it wasn't for the world supporting our currency, we couldn't afford this big military. Donald Trump is making a big deal about how might makes right and how we've got the biggest, stick on the block and, it's our way or the highway, right? That's what he's saying. That's what he's talking about when he's talking about Greenland, right? Donald Trump, hey, we want Greenland. The U.S. is going to acquire Greenland. But he's saying that, well, he'd like to buy it, but if the Danes don't cooperate and sell it to us, or, the people of Greenland don't decide they want to join the United States, he's saying that military option is not ruled out. Meaning, if we can't do a deal, we're going to invade you. We're going to occupy Greenland. We're going to send our troops into Greenland. Because that's basically what he's saying when he said, look, we're going to get Greenland. We'd like to buy it. But if we can't make a deal, I'm not going to rule out taking it by military force. What is he saying? And he's also basically trying to tell the people of Greenland or, Denmark, I'm making you an offer you can't refuse, right? Because it's not a real negotiation if one party says, look, if we can't make a deal, I'm just going to take it by force. And there's nothing you could do about it because we're the United States. That's what Trump is saying. He keeps talking about how powerful our military is. We could do whatever we want. Nobody could withstand us. Nobody can stand up to us, right? Because look at what we just did in Nicaragua. We could do this anywhere. They say, yes, he has been indicted for crimes, right? But you're talking about a head of state. I mean, not a head of state that I, like, as I said, but obviously, if you go into a country and you basically kidnap their president, even if you've convicted that president of some crimes, that's an act of war, right? What would we think? What if some Chinese court convicted Trump of something, right? And then they sent troops in here and they grabbed our president and they said, well, we're just here to arrest Donald Trump. Right? It's just a legitimate arrest. He was charged with a crime in China. And so we came here of course, we wouldn't stand for that. Right. So it is, an act of war.
Looking ahead, many analysts predict that persistent U.S. budget deficits and continued fiscal mismanagement will keep driving investors toward tangible assets, especially gold and silver. With the dollar under pressure from mounting debt and overspending, both metals are expected to see rising demand as a store of value and a hedge against currency depreciation. Gold, already supported by central bank purchases and ongoing geopolitical tensions, is likely to continue climbing, potentially surpassing previous record highs as confidence in paper assets erodes. Silver, with its unique dual role as both an industrial metal and a monetary asset, is projected to experience more pronounced volatility, but overall investor interest is set to intensify, particularly among those seeking protection against inflation and economic uncertainty. Analysts also note that mining stocks and physical holdings could outperform as higher precious metal prices improve mining profitability while production limits constrain supply. Premiums on physical gold and silver are expected to rise as scarcity and demand increase, making timely acquisition critical for investors. The growing appetite from both retail and institutional buyers may drive sharp upward price movements, with silver potentially establishing new support levels above prior lows. The pressing question remains, can the metals market meet this surge in demand without triggering extreme short-term volatility, or is a historic breakout in gold and silver imminent? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution.